Let's start with a simple scenario. Imagine you decide to get serious about your finances. You cut unnecessary spending. You cancel subscriptions you barely use. You start cooking more meals at home instead of ordering takeout. And every month, you manage to save $500. It's not easy. Some months, you have to say no to things your friends are doing. Other months, you feel tempted to skip investing because something fun came up. But you stay disciplined. 3 years go by. That's 36 months of saving. You open your investment account expecting to feel proud. After all, you've been consistent. You've done exactly what every financial expert recommends. Then you see the number, about $19,000. Technically, that's progress, but emotionally, it feels small. My name is Brinny, and I spend way much time thinking about why people who look financially reckless are sometimes better prepared for disaster than people who did everything right. If you've ever felt vaguely unsettled about how dependent your entire financial life is on one company, subscribe and hit. You spent 3 years being disciplined, and the result looks like the price of a used car. Meanwhile, someone at work casually mentions their portfolio grew $40,000 in 1 year. They didn't save that money, the market just gave it to them. And suddenly, you start wondering something uncomfortable. Am I doing this wrong? But here's the truth most people never hear about wealth building. The beginning of the journey feels painfully slow. In fact, it often feels like nothing is happening at all, and that's exactly why most people quit before things start working. When people talk about investing, they love showing the end result, charts that curve upward, stories of people retiring early, screenshots of million-dollar portfolios. But what you rarely see is the first stage, the stage where almost all the progress comes from you, not the market, not compound interest, just your discipline. Let's say you have $5,000 invested. If the market grows 10% that year, you make $500. That's nice, but it doesn't feel like your money is working for you. It feels like your money is just sitting there. Meanwhile, you worked all year saving thousands of dollars from your paycheck. Your brain starts doing the math. You saved $6,000, the market added $500, so your mind concludes something simple. I did basically all the work. And during the early years, that's actually true. Most long-term investors go through a stage that lasts 5 to 7 years where nearly all growth comes from contributions. You're feeding the machine, but the machine hasn't really started moving yet. Imagine trying to push a massive boulder up a hill. Not a small rock, a huge one. At first, it barely moves. You lean into it with your whole body. Your legs strain. You push with everything you have, and the rock shifts maybe a few inches. That's what the first stage of investing feels like. Every month you push a little more money into the system, but the results seem tiny compared to the effort, and that's where most people lose motivation.
During this stage, something else happens that makes things even harder. You start comparing yourself to people who didn't start where you started. Maybe your coworker began investing 10 years earlier. Maybe your friend inherited money. Maybe someone got lucky with a stock or a startup. Whatever the reason, their numbers look dramatically different. Their account grows faster than yours. Not because they're working harder, but because their money has already reached escape velocity. And this creates one of the most dangerous thoughts in personal finance. What's the point? Why sacrifice today for something that barely seems to move? Why not enjoy your money now? Why delay gratification if the reward feels so far away? These questions quietly destroy more financial futures than market crashes ever will. Here's what most people miss. The early years aren't about growth. They're about building the base that growth will eventually multiply. Think of it like building a skyscraper. Before the building rises into the skyline, engineers spend months working underground, digging, pouring concrete, reinforcing the foundation. From the outside, it looks like nothing is happening. There's no visible progress, no impressive structure yet. But the deeper the foundation, the taller the building can eventually rise. Investing works the same way. Your first $20,000, your first $50,000, even your first $80,000. Those aren't the exciting numbers, but they are the foundation numbers. Without them, the later stages can't exist. For many investors, the first major milestone is $100,000. Not because it's magical, but because something interesting happens mathematically around that level. Once your portfolio crosses six figures, the market's movements start to feel meaningful. Let's say you have $100,000 invested. If the market grows 10% in a good year, that's $10,000. Now, something has changed. Your investments produced an amount of money that actually matters. It might cover rent, or a car, or a vacation. For the first time, your money begins contributing something noticeable. You're still pushing the boulder, but now it's starting to move more easily. Here's a realistic timeline for many people. If you invest consistently and avoid major mistakes, reaching $100,000 often takes around 7 to 8 years. That sounds like a long time, and it is. 8 years is long enough to change jobs, move cities, start families, face unexpected setbacks. It's long enough for motivation to fade. Which is why patience becomes the real skill of investing. Not stock picking, not market timing, just patience. Something interesting happens after that first $100,000. The next $100,000 often arrives faster, maybe 5 years instead of 8, not because you suddenly became a financial genius, but because the math has changed. Before, the growth was tiny compared to your contributions. Now, the growth starts to help. Your money has begun doing some of the pushing. And once that shift happens, the journey begins to feel different. But there's still a long road ahead, because the next stage of wealth building introduces a new challenge most people never expect, a challenge that appears right when things finally start getting easier.
Something strange happens after you pass your first $100,000. At first, you might not notice it. Your habits haven't changed. You're still investing regularly, still sending money into your account every month, still trying not to panic when the market drops. But gradually, something shifts. Your investment account starts growing in ways that feel different. Not dramatic at first, just noticeable. Maybe one year your investments grow by $12,000. You stop and think for a second. Wait, I only saved $10,000 this year. That's the first time your money contributed more than you did. And when that happens, the psychology of investing begins to change. The moment the machine turns on. Think of investing like building a machine. In the early years, you're basically assembling it piece by piece. You're tightening bolts, adding gears, connecting parts. Nothing moves yet. But after enough pieces are in place, you flip the switch, and suddenly the machine starts running. The same thing happens with compound growth. Once your portfolio gets large enough, it begins producing meaningful gains on its own. Not every year. Markets are unpredictable. Some years are bad, some years are great. But over time, the pattern becomes clear. Your investments are no longer passengers. They've become engines. The 200K phase. For many people, the jump from 100,000 to 200,000 happens much faster than the first climb. Maybe 5 years, sometimes even less. And the reason is simple. The market is now doing more of the work. Let's say you're investing $15,000 a year. At $100,000 invested, a typical 8% market return produces about $8,000. But once you reach $200,000, that same 8% return produces $16,000. Your investments are now contributing roughly the same amount as your annual savings. You're no longer pushing the boulder alone. The slope is starting to tilt in your favor. When growth becomes visible. Once your portfolio reaches somewhere around $300,000 to $400,000, the experience of investing changes again. Now, market movements start creating numbers you can actually feel. A strong year might add $40,000 or $50,000 to your portfolio. You didn't save that. You didn't work overtime for it. It just appeared because you owned pieces of businesses that grew in value. And that realization can feel almost surreal. You go to work every day, you trade hours for money, but somewhere in the background, your investments are quietly producing wealth on their own schedule, sometimes faster than your job can. The psychological shift. This is the point where something interesting happens inside your mind.
You begin to realize that your income no longer comes from just one source. Your paycheck is still important, but it's no longer the only engine driving your financial life. Your investments have become a second system operating in parallel, one that doesn't depend on your boss, or your company, or even your career. That's when people start to feel the first taste of real financial stability. Not wealth, not freedom yet, but stability. The danger of early celebration. Unfortunately, this stage introduces a new risk. After years of discipline, things finally start working. Your portfolio is growing, your net worth looks respectable, and for the first time you might feel like you've made it. That's when many people loosen the habits that built their success. They upgrade their lifestyle, move into a bigger apartment, lease the nicer car, book the expensive vacation. None of those things are inherently bad, but they often come with a hidden cost. Your savings rate drops. The money that used to feed your investments starts going somewhere else, and suddenly the machine you spent years building stops accelerating. The velocity problem. Wealth building isn't just about the total amount you have.
It's about velocity, how fast your wealth is growing. When you reduce contributions during this stage, you slow down the snowball right when it's gaining momentum. Imagine you've built a huge snowball halfway down a hill. It's finally rolling on its own. Then you stop adding snow to it. The snowball will still move, but it won't grow nearly as fast as it could have. And that difference compounds over time. The $1 million horizon. Let's say you reach around $600,000 or $700,000 invested. At this level, something interesting happens again. The jump to $1 million begins to feel closer than you expect. Not because the goal changed, but because your assets are now large enough to create significant growth each year. For example, an 8% year on $700,000 produces about $56,000. Add another $20,000 in contributions from your income, and suddenly you're adding more than $75,000 per year to your net worth. At that speed, the path to seven figures becomes surprisingly short. 4 years, maybe 5. Sometimes even faster during strong markets. The $1 million milestone. Reaching $1 million invested is often seen as a major life milestone, not because it instantly makes you rich, but because of what it represents. At $1 million, a typical 8% return produces $80,000 in growth. That's close to the entire annual salary of many workers. Your money is now capable of generating an income similar to a full-time job without you doing anything. That's the moment when people realize something powerful. Their financial future is no longer tied entirely to their labor. Their investments have become a serious economic force. The quiet realization. But something interesting happens when people actually reach this milestone. Most don't celebrate the way they expected. There's no fireworks, no dramatic life change. Usually, it's just a quiet moment. You log into your investment account, see 7 figures, pause for a second, then close the app and continue your day. Because the real reward wasn't the number, it was the system you built to reach it. A system that works even when you're not thinking about it. But a new problem appears. Once people reach this stage, another temptation appears. They start believing they should be doing something more sophisticated with their money. After all, having $1 million feels significant. Shouldn't you be doing something smarter than simple investing? Maybe real estate? Maybe private investments? Maybe starting a business? And while those opportunities can sometimes be great, they also introduce risks that weren't present before, because complexity often replaces consistency, and consistency is what built the wealth in the first place. The trap of getting fancy. Many investors accidentally slow their progress here. They start chasing strategies instead of staying disciplined. They move money around, experiment with new investments, try to optimize everything. But historically, the most powerful strategy has been surprisingly boring. Consistent investing, long time horizons, minimal interference. In other words, let the machine run. The stage most people never reach. Here's the uncomfortable truth. Most people never reach this level, not because they lack intelligence, not because they lack opportunity, but because they quit during the slow years. They stop pushing the boulder before gravity finally begins to help. And that's why the early phase matters so much, because if you survive it, everything begins to accelerate.
But acceleration brings its own strange challenges. There's a stage of investing that almost nobody talks about, not because it's secret, but because most people never reach it. It's the moment when your investment portfolio starts moving in numbers that feel almost unreal. You might wake up one morning and check your account, and it's down $25,000. Nothing dramatic happened, no financial crisis, just normal market movement. At first, that kind of drop feels terrifying. Your brain immediately starts doing the math. Wait, that's half a year of my salary. Your instinct is to panic. But then something strange happens. A few weeks later, the market rebounds, and suddenly your account is up $35,000 without you doing anything. No extra work, no extra savings, just market momentum. And that's when the psychology of wealth building becomes far more complicated than the math. When numbers stop feeling real. Earlier in your investing journey, every dollar mattered. You noticed every contribution, every deposit felt meaningful. But once your portfolio reaches several $100,000, the numbers begin behaving differently. Let's say your investments grow to around $700,000. Now an average market return of around 8% could produce about $56,000 in a year. Think about that for a second. You might have spent the entire year working, saving maybe $20,000 from your income, but your investments produced nearly 3 times that amount without you lifting a finger. That realization changes how you see money. Your portfolio isn't just growing, it's producing wealth at a scale that begins to compete with your career. The moment your money overtakes your effort. For many people, there's a specific moment when this becomes obvious. Maybe it happens during a strong market year. You check your portfolio growth and realize something surprising. Your investments earned more money that year than you did at your job. Let that sink in. Your job required meetings, deadlines, commutes, stress. Your investments required nothing, just time. That's when people begin to understand the real power of long-term investing. Because the ultimate goal was never just building a large number. The goal was building a system that works even when you're not working. Why this stage feels so strange? Oddly enough, this stage can feel emotionally uncomfortable. You spent years working hard to reach this level, but now the numbers moving around your account feel disconnected from your effort. A bad month might drop your portfolio $30,000. A good month might add $40,000. And neither number came directly from your actions. It's just the market doing what markets do. Some people struggle with this psychologically because humans like to feel control over outcomes. But the stock market doesn't care about control. It only cares about time, growth, and volatility. The hidden advantage. If you can accept that reality, something powerful happens. You stop reacting emotionally to every market movement. You begin to see the bigger picture. Because when your investments reach this level, short-term swings become less important than long-term growth. Think of it this way. If you're investing for the next 20 or 30 years, today's fluctuations barely matter. They're just noise in a much larger story. And once you truly understand that, investing becomes surprisingly peaceful. The real crossover point. There's a point in wealth building where your financial life fundamentally changes. Not when you reach $1 million, not when you retire, but when your investments can generate more income than your job. This doesn't mean you stop working. Many people continue working for years, but the pressure changes. Your survival is no longer tied to a single paycheck. You've built a second engine, one that doesn't depend on your time. That's the beginning of real financial independence. The temptation that appears. Ironically, this is also the stage where many people make their biggest mistakes. After watching their investments grow, they begin feeling confident, sometimes a little too confident. They start thinking they should do something bigger with their money. Maybe they pull a large chunk of their portfolio to invest in real estate, or they try to start a business, or they begin trading individual stocks aggressively. The logic sounds reasonable. If I've built this much wealth, imagine what I could do if I took bigger risks. But this is where people forget something important. The strategy that built their wealth was patience and consistency. Changing that strategy can destroy the momentum they spent years creating. The complexity trap.
There's a common belief that wealthy people must use complicated strategies, private investments, advanced tax structures, sophisticated financial tools. And sometimes that's true, but often the most effective strategy remains the simplest one: long-term investing, diversification, consistency. Many people who reach high levels of wealth do something surprising. They stop trying to outsmart the system because they realize the system is already working. The million-dollar perspective. By the time someone reaches around $1 million invested, the scale becomes even more dramatic. A typical 8% year now produces $80,000 in growth. That's more than many households earn annually. And suddenly, your perspective changes again. You realize that your portfolio could continue growing even if you stopped contributing new money. Time alone could do most of the work. This is where the snowball effect becomes impossible to ignore. Your wealth is no longer crawling forward, it's rolling. But money doesn't solve everything. At this point, many people expect to feel completely secure. After all, they've achieved what most investors dream about. But another realization appears. Money removes certain problems, but it doesn't automatically create purpose. You might still wake up on Monday morning wondering what you actually want from life. Because financial independence changes your options, but it doesn't choose your direction. And that realization becomes even more important in the next stage. The final psychological test. As your portfolio continues growing, another challenge appears. Not mathematical, psychological. Because when you see large numbers sitting in your investment account, temptation grows. You begin thinking about all the things that money could buy right now. A bigger house, luxury travel, helping family members, early retirement. None of these desires are wrong, but every major withdrawal comes with an invisible cost. Not just the money you spend, but the growth that money could have created in the future. And understanding that trade-off becomes the final skill of long-term wealth builders. The discipline that separates outcomes. People who reach true financial independence usually share one habit. They protect their investments during the years when growth accelerates the most. They don't interrupt the compounding process. They allow their portfolio to continue expanding even when spending the money would feel good in the moment. That discipline is what eventually creates the freedom most people are chasing.
At some point in the journey, something strange happens. You stop worrying about whether you can build wealth, and you start wondering what you're supposed to do once you have it. This moment doesn't arrive suddenly. It creeps up on you. One day, your investments pass $1 million. Then a few years later, they're closer to $1.5 million. And eventually, you realize something remarkable. Your portfolio is now large enough to support your lifestyle. Not partially, completely, for decades. Financially speaking, the math says you're free. But strangely, many people keep working anyway. When work becomes optional. There's a popular idea that people will immediately quit their jobs the moment they can afford to. But in reality, that's rarely what happens. Because after spending 20 or 30 years working, your career becomes more than just a paycheck. It becomes part of your identity, your routine, your social structure, your sense of usefulness. So when financial independence finally arrives, the real question isn't, can I stop working? The real question becomes, who am I if I do? And that question turns out to be far more complicated than most people expect. The final boss of wealth building. Throughout the entire investing journey, the biggest challenges seemed financial. Saving consistently, staying invested during market crashes, ignoring distractions. But once the numbers are large enough, the biggest challenge becomes psychological. Because suddenly you have options that once felt impossible. You could retire early. You could travel the world. You could take years off work. You could start an entirely new career. All of these choices become available. And ironically, having unlimited choices can feel overwhelming. The temptation of early rewards. At this stage, another temptation appears. You've been disciplined for decades. You sacrificed vacations, delayed purchases, stayed patient while your investments grew. Now the money is finally there, and naturally you want to enjoy it. Maybe it's a vacation home. Maybe it's helping your children financially. Maybe it's traveling the world. None of these desires are wrong, but there's something important to understand. Large withdrawals don't just reduce your current balance, they reduce your future growth. Because every dollar invested today has the potential to multiply over time. The invisible cost of spending. Let's say someone has $1.5 million invested. They decide to withdraw $100,000 for a major purchase. It feels manageable. After all, the portfolio still looks large. But what's easy to forget is the future value of that money. If that $100,000 stayed invested and grew at around 7% per year for 20 years, it could become nearly $400,000. So the real cost wasn't just the purchase price, it was the growth that money would have created. This is the hidden trade-off every wealthy investor eventually faces. Spend now or let the machine keep running. The compounding machine. By the time a portfolio reaches several million dollars, the math becomes almost unbelievable. Let's say someone has $3 million invested. A 7% average return produces around $210,000 per year. That's more than many professionals earn from their careers. And the investor didn't need to attend meetings or commute to work or negotiate a salary. The portfolio simply kept growing. This is what people mean when they talk about financial freedom. Not unlimited luxury, but the ability to live comfortably without relying on a job. But freedom comes with responsibility. Even at this stage, discipline still matters, because wealth can disappear faster than people expect. History is full of examples of athletes, entrepreneurs, and lottery winners who lost enormous fortunes, not because they were unintelligent, but because they underestimated the importance of protecting what they built. The habits that created wealth must continue protecting it. Patience, moderation, long-term thinking. Without those habits, even large fortunes can shrink quickly. The purpose problem. But there's another challenge most people don't anticipate. When work stops being necessary, life suddenly contains a lot of empty space. For decades, your schedule was structured. Work filled your days. Your goals were clear. Deadlines kept you focused. Without that structure, some people feel lost. Because money can provide freedom, but it cannot automatically provide meaning. The people who thrive. The individuals who enjoy financial independence the most usually have something in common.